On Thursday, something snapped. Not a rumor, not a vibe, a mechanism. Silver didn't have a good day. Silver crossed the one line it was not supposed to cross on options expiration, and that single close turned the silver miners into a runaway train. If you blinked, you missed the ignition. Here's what actually happened. The market tried to pin silver under a critical strike. It tried to choke the calls. It tried to suffocate momentum before it could breathe, and then the price refused. Silver clawed back, closed above the danger zone, and the hedge books flipped from comfortable to catastrophic. That is why Friday exploded. This is the warning. The next leg can start while you're trying to decide. This is John A.G., and you're watching The Currency Academy by John A.G. Now listen closely, because this isn't a cute rally story. This is a setup, a trap. And when a trap snaps shut, it doesn't do it slowly. It does it in one violent repricing candle that leaves people staring at their screens asking, how did that happen so fast? It happened fast because it wasn't emotional buying. It was forced buying, and forced buying has no patience. Friday was proof. Silver moved like it was in control. The miners moved like they were possessed. The silver miners ETF ripped roughly 3% in one session, while silver itself was up only about 1%. That's close to 4-to-1 leverage in a single day. 4-to-1 on a day the metal barely stretched its legs. So let me ask you the question nobody wants to answer out loud. If miners can do that when silver is only up 2%, what happens when silver actually runs? Because that is the cliff you're walking toward right now. And I don't want you waking up 2 weeks from now, watching the charts go vertical, pretending you didn't have a warning. You did. This is the warning. The story starts with one boring word that hides a brutal reality. OPEX. Options expiration. That's the day the casino cashes the chips. That's the day a mountain of paper bets either dies quietly or detonates loudly. And on Thursday, January 16th, the market chose detonation. The morning opened like the oldest trick in the book. A fast smash, a sharp drop, a sudden hit designed to make you think the move was over. Silver got clipped in minutes, the kind of drop that triggers stop losses, shakes weak hands, and convinces the average trader to play it safe and bail. That's the psychological warfare part. But the real game wasn't psychology, it was mathematics. Because while the chart was flashing red, someone was staring at an options chain with a completely different mission. Keep price below the strike, keep the calls out of the money, let them expire worthless. If you sell call options, that's the dream. You collect premium, you walk away, and you smile while retail argues about resistance lines. But when price refuses to stay pinned, that dream turns into a liability, and liabilities don't care what you believe. They get paid. Here's the key detail that separates amateurs from professionals. Market makers hedge, not because they want to, because they have to. They don't hedge on opinions. They hedge on exposure. And exposure changes when price crosses a strike. A call option out of the money has low delta. That means it behaves only a little bit like the stock. The dealer doesn't need many shares to stay neutral. The hedge is light, the risk feels manageable. But the moment price rises into the strike, delta climbs fast. That forces buying. And that buying pushes price higher. And higher price makes delta climb even faster. That forces more buying. That loop is called gamma. Gamma is the accelerator. Gamma is what turns a nice day into a squeeze that melts faces. And that is what you saw on Friday. But Friday wasn't the beginning. Thursday was the trigger pull. Because Thursday was the day the market tried to crush silver under the key zone, failed, and accidentally lit the fuse. Let's rewind. Thursday morning, silver drops hard. The tape looks weak. The commentary gets smug. The "it's over" crowd crawls out of the sewer. For a moment, it looks like the pin will work. Then the buying shows up. Not the cute, scattered buying you see from retail. I'm talking blocks, size, heavy prints. The kind of orders that don't tweet, don't celebrate, and don't hesitate. Silver starts climbing back like it's being pulled by a rope. And by late morning, you can feel it. The tone changes. The sellers stop pushing. The bids stop flinching. And as the afternoon approaches, silver is back above the level that matters most. That close matters more than any intraday wiggle, because OPEX pricing is a scoreboard, not a mood. When silver closes above the strike on expiration week, the entire hedging structure changes. Calls that were supposed to die suddenly breathe. Exposure that was supposed to be contained suddenly expands. And the people who sold those calls wake up staring at a risk profile that just got much more expensive. That is how a squeeze starts, not with a headline, with a settlement. Now, I want you to understand something that will change how you see moves like this forever. The market doesn't always move because investors feel bullish. Sometimes the market moves because someone is trapped. Trapped by math, trapped by positioning, trapped by a bet that assumed price would behave, and price didn't behave. It disobeyed. Now we arrive at Friday, January 17th, and Friday was the confirmation punch. silver pushes higher, not explosively, but steadily. And the miners? The miners go insane. They don't creep, they don't grind, they launch. That 3% rip wasn't just optimism. It wasn't sector rotation. It wasn't a cute little bounce. It was dealers chasing hedges. It was desks scrambling to neutralize risk. It was the market correcting an accounting problem in real time. Markets hate accounting problems. Accounting problems create urgency. Urgency creates speed. Speed creates panic. And panic creates the kind of repricing that looks impossible until you remember one simple truth. The market is not always a free choice democracy. Sometimes it's a forced march. Now here's where the story gets more dangerous. Because once a gamma squeeze begins, it doesn't need you. It doesn't need retail. It doesn't need a narrative. It needs only one thing: continuation. If price stays elevated, the hedging requirement stays elevated. If the hedging requirement stays elevated, the buying stays elevated. And if the buying stays elevated, the move feeds on itself. That's why the next couple of weeks matter more than the last couple of days. Because a one-day rip is fun. A multi-week forced repricing is life-changing. So what confirms this is real? 3 things. 1. Miners keep outperforming the metal. If silver is up 1% and miners are up 4% again, you're watching leverage and hedging pressure stay active. 2. Dips get swallowed. In normal markets, pullbacks linger. In squeezes, pullbacks disappear. Buyers show up like they were waiting for permission. 3. Earnings season adds gasoline. Because a squeeze can spark a move, but earnings can legitimize it. Earnings are where the market stops arguing and starts reading. It's where cash flow replaces opinions. And cash flow is the only language big money respects. Here's the operating leverage reality that people underestimate. Miners don't move linearly with silver. They move exponentially when margins expand. If a miner produces silver at an all-in cost around the low 30s, and the metal is trading in the 90s, the profit per ounce is not a little higher. It's enormous. And when profit becomes enormous, valuation becomes a joke. Stocks that were priced like survivors suddenly need to be priced like cash machines. That's the re-rating. That's the repricing. That's the part where the chart stops asking for your consent. And that's why Friday mattered. Friday was the market whispering, we're not pricing this the old way anymore. Now pause for 1 second and think about the psychology that usually kills people in setups like this. Most investors are trained to wait. Wait for confirmation. Wait for mainstream coverage. Wait for a safe entry. But squeezes don't wait for you. Squeezes punish the patient and reward the prepared. Because the move looks boring right until it becomes unstoppable. And when it becomes unstoppable, the entry you wanted is gone. That's why you need a framework, not feelings. So here's the framework I'm watching, and you can watch it with me. First checkpoint is the first real open after this week's emotion settles. If miners gap up and hold through the first hour, that's strength. If they gap up and instantly dump back below the breakout zone, that's caution. Second checkpoint is whether pullbacks hold above prior resistance. In a real repricing, old resistance becomes new support. That's how you know the regime shifted. Third checkpoint is how the next option's wall behaves, because this was one strike event. There is always another strike. There is always another wall. And the question is simple. Do they pin it again? Or does price run through it and force another round of hedging? That's where things get wild. Now, let me explain gamma in the most practical way possible, without turning this into a textbook. Imagine you sold 1,000 call options on a miner's ETF, and you did it because you thought the price would stay below the strike. As long as the price stays below, you're fine. Those calls have low delta, so you barely hedge. But if the price rises into the strike, delta climbs. Now you must buy shares to hedge. Your buying pushes price higher. As price rises, delta climbs more. Now you must buy more shares. That buying pushes price higher again. That's the loop. And in a crowded strike, it's not one dealer, it's many. All buying at once, all chasing the same hedge, all praying for a dip that never comes. That's how a squeeze goes vertical. Not because everyone loves silver miners, because everyone is trapped in the same door. Now, if you're still thinking this is just technical, I want you to recognize the deeper layer. This isn't only about options. It's about a sector that has been ignored while the underlying metal has been tightening. It's about physical premiums staying stubborn. It's about inventories that don't magically refill because a chart went down for 2 hours. It's about industrial demand that doesn't care if you feel overbought. And it's about financial positioning that is now unstable. You can call it manipulation, you can call it hedging, you can call it rebalancing, but you can't call it random, because random doesn't print 4-to-1 leverage days. Forced systems do. Now let me ask you 2 quick questions, and I want real answers in the comments. Do you want updates only when the move is already obvious, or do you want the mechanics explained the moment they flip? And second, what's your biggest mistake in past bull runs? Buying late, selling early, or getting shaken up by fake dips? Drop your answer below, because your experience might save someone else from repeating the same mistake. And don't forget, subscribe to support the original work. And if you're a part of the movement against copycats, comment John A.G. Best so I can see you. Now, here's what most people will miss next. The loudest phase of the move often starts after the first rip, not during it. The first rip is the signal. The next phase is the chase. And the chase phase is where price action becomes emotional. You'll get days where miners are up 5% by lunch, and you'll see people posting easy money screenshots. Then you'll get a sudden midday dump that wipes out late buyers, triggers panic, and resets the playing field. That volatility is not an accident. Volatility is a weapon. It shakes out weak hands and forces mistakes, and the people who lose in squeezes aren't always the ones who picked the wrong direction. They're the ones who couldn't handle the whipsaw. That's why pacing matters. That's why discipline matters. That's why you don't size your position based on excitement, because excitement is how markets harvest you. Now, I want to address the biggest objection I'm seeing already. Costs are rising. Miners won't make that much. Yes, costs rise. Diesel rises, labor rises, equipment rises. But the real question is, did costs rise as fast as price? No. Silver moving from mediocre levels to the 90s is not a normal event. Margins can expand even in inflation when the product price outruns the input price. And expanded margins are what create re-ratings. Now another objection. Governments will take it. Windfall taxes, nationalization. That risk exists. But policy moves slower than price. Price can reprice in weeks. Policy can take months or years. And in the early phase of a move, the market doesn't wait for legislation. It moves first and asks questions later. That doesn't mean ignore risk. It means understand timing. Timing is everything. Now, the third objection. They'll smash it again. Maybe they try. They always try. But here's the thing. Once positioning is stretched and hedging becomes mandatory, the smash becomes harder, because every dip becomes a buy program for someone trying to survive their exposure. That's why squeezes are so vicious. The more they try to stop it, the more they may feed it. Now let's zoom out and talk about why miners can outperform even without a massive silver spike. Because the market is still pricing miners like they're fragile, like they're risky, like they're a nuisance. But at high metal prices, these companies can generate cash like machines. When a company starts printing cash, three things happen. Balance sheets strengthen, buybacks become possible, dividends become possible. And suddenly, investors who used to ignore the sector start hunting it for yield and value. That's the slow flood. And the slow flood becomes a stampede when momentum joins. So the question becomes, are we at the edge of that shift? Friday looked like yes. But I want to be precise. One day doesn't guarantee a trend. A trend is proven by behavior, so watch behavior. Does price hold gains? Do pullbacks stay shallow? Do miners keep leading? Do earnings confirm? If yes, the thesis strengthens. If not, the move cools. That's it. No drama needed, just observation. Now, let me paint the sequence I think we're watching, because sequences create clarity. Step 1, OPEX pin attempt fails. Step 2, close above strike forces delta hedging. Step 3, miners pop hard as hedging spills into equities. Step 4, pullback attempt gets bought quickly. Step 5, earnings season validates margins. Step 6, analysts upgrade, funds rebalance, and liquidity floods in. Step 7, the story becomes mainstream and the final phase becomes chaotic. We're somewhere between step 3 and step 4, which means the quiet advantage is still there. It won't stay quiet. Because once people smell momentum, they stampede. Now, there's a brutal truth about YouTube finance and markets. Most people don't want the truth early. They want the truth when it's safe. But safe is expensive. Safe is after the move. If you want cheap, you need clarity before the crowd. That's what this channel is for. Now, let's talk about the part that creates the sharpest moves. Short interest. When miners start ripping, shorts don't just lose money, they lose control. They start getting margin calls. They start covering into strength. Covering is buying. And buying into strength is gasoline. So if you have options hedging plus short covering plus earnings confirmation, you have a 3-engine push. That's how you get the kind of chart that looks like a glitch. And that's what Friday looked like, a glitch. But glitches in markets are usually not accidents. They're warnings. They're the system showing you strain. They're the moment the paper setup collides with reality. Now I want to give you one more mental tool because it will keep you sane. Stop obsessing over the daily tick. Start watching the spread between silver and the miners. When miners are leading, the market is pricing future profitability. When miners lag, the market is doubting the move. Friday was miners leading hard. That's what made it special. That's what made it different. Now, I'm going to leave you with a scenario, and I want you to think about it before you sleep tonight. If this was only a one-day hedging burst, price will fade fast and drift back into the old range. But if this was the first crack in the pinning mechanism, the next 2 weeks will feel like the market is accelerating. It won't be linear, it will be violent, it will be emotional, and it will punish hesitation. So here's my final question for you. Do you think we're watching the start of a genuine multi-week repricing? Or do you think the market tries one more big fake out first? Drop your call in the comments because I want to see who's reading the mechanics and who's reading the noise. Take care of yourselves, take care of each other, and I'll see you in the next video soon.